we're going mainstream. Everybody's gonna eat, we're going mainstream. All my family is sing. See you on Main Street, we're going mainstream.
From Wall Street to Melrose Avenue,
We're going mainstream.
venture capitalists to athletes to
We're going
creators
mainstream.
to the person who's collected trading cards
We're going mainstream.
in a collision of culture and finance.
We're going mainstream.
Welcome back to the Alco's Mainstream podcast. Today we sit down with a technology and fund services veteran who has worked with many of the industry's largest asset managers. Cesar Estrada is private markets head at Arcesium, a global financial technology company delivering pre- and post-investment operations and enterprise data management solutions designed to systematize the most complex workflows. Arcesium was built from a platform developed and tested by investment and technology development firms D.E. Shaw Group, and launched as a joint venture with Blackstone Alternative Asset Management. JP Morgan, another large client, later made a strategic investment in the company, helping Arcesium further its mission to power the entire investment lifecycle. Cesar is responsible for Arcesium's data management and investment operations technology and services offered to private markets fund managers and investors. Previously, he served as Senior Managing Director and Alternatives Business Head for North America at State Street, a role in which he drove the growth agenda for a business with approximately $1 trillion in assets under administration by leading new product launches, expansion into new client segments, strategic partnerships, and acquisitions. He served on the board of State Street Fund Services, Inc. And prior to that, as a managing director at JP Morgan, Cesar led the private equity and real estate fund services businesses from launch to $350 billion in AUA. Cesar and I had a fascinating conversation about the impact of technology and automation on private markets. We discussed what private markets going mainstream means for pre- and post-investment operations, why alternative asset managers need to have technology solutions to manage, track, and analyze data and workflows if they want to scale, the biggest challenges alternative asset managers face as they handle the increase in data management, more funds, and more investors, what technology or workflow solution is still missing, how much AI will impact technology workflows in private markets, and why ABF has become such an important part of the private credit ecosystem. Thanks, Cesar, for coming on the show to share your wisdom and experience in private markets.
We're going mainstream.
Cesar, welcome to the Alco's Mainstream podcast.
Thank you, Michael. I'm glad to be here.
Pleasure to have you. You have such a fascinating background working with many of the leading alternative asset managers and asset managers. You're now building critical technology solutions for the industry, particularly in private credit, which we'll get to. I would love to start with your background and hear how you got to Arcesium today.
Yeah, absolutely. I spent 25 years in fund services with large financial institutions, and I had the privilege of seeing how private markets, mostly focused in private markets during that time, the last 20 for sure, and I have seen the private markets grown from to this tremendous size, and have seen it reinvent itself and come up with new things through global financial crisis, through pandemics. And I can't wait to see what happens in this new chapter with all of this market volatility and uncertainty. I'm sure the creativity will thrive again. I got to see that. I got to see the fund services industry go from being a little cottage industry in some offshore locations to being dominated by banks for a period of time, to shifting to the non-banks, and now these days being a hot property owned by many private equity sponsors, consolidating the industry. But most rewarding, I guess, has been working with CFOs, CTOs, COOs, seeing their roles evolve in complexity and responsibility and helping them with some of their problems. That led to, to having views on how technology should be playing an ever-increasing role in private markets. And I felt at some point, after 25 years, that it would be more conducive to do so at a tech company. I guess on a more personal note, I have an entrepreneurial vein of sorts. I don't have the guts to go out on my own and exercise it, But I did have an itch that I needed to scratch in a bigger way than I could at a large financial institution. And we had a meeting of the minds with Arcesium's management team and board. They have great core competencies on data management and investment operations, and they wanted to apply those to private markets. So I came in to help with that.
Well, I think that brings up a really important point in private markets. Not always the case, but I think in a lot of successful cases with private markets technology companies is they're actually started from the industry itself. So you're scratching your entrepreneurial itch, but doing it with some of the largest, most established firms in the industry. So how does that help build the business in a way that maybe if you started a business?
The firm will be turning 10 this year. And it started as a joint venture between D. Shaw and Blackstone, and then subsequently JP Morgan as well. So it helps in two ways, the way I see it. One, you are, in our case, our technology is architected and viewed through the lens of the manager, because we came out of managers and we serve managers by and large. And two, a lot of their complexities are applicable across a much broader range of managers in different strategies. In our case, we also happen to stumble with this trend of all asset classes, public and private, in some way, and through different lenses coming together. And the technology had been architected to deal with illiquid, tradable, and listed asset classes from the start. So it is not a product of different acquisitions that were only partly integrated over time, but rather it is just a single piece of code to serve any type of asset. The other thing that comes quite handy, I guess, is I'm used to living in a public company. My clients are sponsors, so they own a private company, so I get to see that from a distance. But our ownership model is different. I guess you could see it as some sort of a client consortium, perhaps. Our owners would appear to be financial sponsors. They are. But they own us out of a balance sheet as a strategic vendor for them. And as such, that informs and permeates to the DNA of the firm and our culture. It is very client-centric because our clients own us, because we are an important piece of their infrastructure.
On that point, you're building for some of the biggest in the industry. How much does building for the biggest make it easier to then go down market? Or many startups, just to kind of compare and contrast, many startups start going after smaller customers and then work their way up to more enterprise size customers. Not always, right? There are firms who start with enterprise level clients and then build down from there. But how does that help you as you serve the asset management industry broadly?
It's very helpful because having solved some of the more complex problems and with smaller, newer, high growth managers being these days more forward-looking, more trying to get ahead and solve not only today's problem, but tomorrow's problem, we can be there early on and be cost-effective for them to just use the things they need to solve the problem, and then over time help them get to their target state and as they grow bigger. So generally, the obvious answer there is the problems we find out there with the smaller firms are generally a subset of problems of bigger, more complex firms. We've encountered them before. Having said all that, every firm looks at the same problem slightly differently and want to handle its solution, and how they look at analysis and reporting differently, and we try to remain flexible in that regard.
What do you think managers did in the past? You were at State Street and Fund Services, worked with many of the largest alternative asset managers. You probably had a window into their technology and operations and data management. What did they do in the past and what are they doing today?
And before answering the question, the circumstances they faced in the past were they all started as and were successful at something, as a buyout firm, as a direct lender. And over time, what has happened is they have diversified across asset classes, across investment strategies, across fund products, and across distribution channels. So the drawdown fund was everything they had. They had a few of those carried interest funds, and now they have evergreen funds and registered funds. They have different. So the circumstances have changed as they've grown and diversified. They become more complex. How they did things before, well, they started as Excel shops. Excel remains a very important tool for a number of things, but most have outgrown it to now adopt what I'll call functional solutions for different areas. A CRM for investments and for deal pipeline, a portfolio monitoring tool to keep track of portco level details, an accounting tool, a waterfall calculator, and usually multiple fund administrators, custodians, and other agents. And what that has created is data silos. And as they attempt to cross-sell now their different products across their increasingly overlapping clientele, they need to bring data back together. As they attempt to fulfill regulatory requirements in different markets, they need to bring data together. As their own managing partners need to understand and make decisions, they need to bring data together.
What are you seeing as some of the roadblocks with firms that haven't yet adopted the technology solutions that help harmonize the different parts of the firm and the data silos? And what I'm kind of getting at here, and we'll get into this in more detail, is particularly as firms think about things like evergreen structures, serving the wealth channel, you really need harmonization across pre-investment, so the deal team, all the way through to managing the investment, post-investment operations, investor relations, the wealth solutions business. All that needs to be harmonized. What are you seeing with firms that have yet to adopt the technology solutions to harmonize those different silos, both teams and data silos? And then what's the realization point that they're like, okay, we actually need to have some sort of technology solution to bring that all together?
Operations and technology become a true bottleneck for new product launches. And that is something hard to swallow because you have been growing and operations has never stopped you from going into something new. You throw more people at it, you throw some incremental level of technology. But when you go into, say, to your example, an evergreen structure, which might have liquidity windows where NAV errors become much more consequential, where the frequency of the reporting and the valuations is no longer quarterly, but could be monthly, could be even daily in some cases, then that's the trigger point. That is, I can no longer do it this way. I need a better one.
When do firms start thinking about needing technology solutions as it pertains to the strategic imperative to grow their business, particularly as it relates to deciding to go into the wealth channel?
Yeah, I think the triggers tended to be, in our experience, a combination of as they try to differentiate themselves on an investment strategy and do something new, we're not going to do a mid-market U.S. direct lending fund this time, but rather we're going to bring in also some real estate lending, some consumer, some this, some that, and have different sleeves. So as you add complexity to the investment side of the equation and you add complexity to the fund structure, and with new economic arrangements, with regulation, with liquidity, and you have a new set of clients and their intermediaries, you you tend you need outside help. Most of the infrastructure of private markets was built on the back of institutional clients being the main client. And today with not only private wealth, but also insurance evolving from a traditional LP to a much more intimate relationship, particularly with private credit, they have a growing number of needs. They look at things differently. So the recognition of needing more modern technology if you're going after private wealth and or insurance in a bigger way is there clearly.
How do you think asset managers are thinking about the strategic elements of technology and how it can help shape their business going forward? What are they doing from a hiring perspective, from a strategy perspective, from an implementation perspective?
They are thinking about things more systematically in terms and more deliberately in terms of, to put it very bluntly, a desire not only to dig themselves out of a hole if they have gone through a period of a very high growth where there's a need for data and technology infrastructure to catch up, but further, more looking out and saying, well, we want to double our AUM yet again in the next 3-5 years or whatever the case might be. And we recognize it can't be done the way we did it before. And then there is an exercise of understanding the current state and the target state, and more importantly, understanding the different ways that you can get from point A to point B.
So on that point, there's all sorts of really interesting and important point solutions, particularly post-investment or post-trade. Same happened in other market structure evolutions across equity, fixed income derivatives. We're now seeing that be built out in private markets. How do you think about the landscape of point solutions versus either end-to-end or solutions that harmonize various aspects of the life cycle of an investment that are critical in making sure firms are able to do the things they want to do and deliver for investors the way they want to?
Yes. I think both will coexist for the foreseeable future. In the case of Arcesium, we play on both ends of the spectrum as a data platform to harmonize everything, to break the data silos, but also as an operational platform to help streamline investment operations, accounting, treasury, investor allocations, reporting. And both do coexist. There are different schools of thought as to whether you should go for best of breed in each component or find that elusive platform that can do it all, which happens to be our value prop. But I think what's very important is for managers to achieve value quickly. And the idea of the multi-year implementations is too overwhelming in a time of so much change. So finding in that road from A to Z ways of adding value in increments and accelerating the path to the target state is critical.
We've talked a little bit about this, how the CTO is becoming a more important and more strategic role in the evolution of alternative asset managers as businesses. How much is their role to find the best of breed point solutions or to find the platform that can help implement and be more of the end-to-end solution? And how are firms thinking about the difference between the two?
Yes. The role of the CTO over the last few years has evolved, not unlike the CFO evolved from being a more finance and accounting centric role to today being that, plus being a strategist and supporting all areas from fundraising through product development and the day-to-day operations. The same is happening with the role of the CTO. It's been elevating by the fact that the businesses are becoming more complex. And certainly the selection of technology and those choices are a critical component. The balance between control and delegating or partnering with third parties is something that they need to calibrate based on the strategy of the firm and figure out what that right point is. The traditional build versus buy decision, what we see is it's more seen these days rather than two discrete points, more of a spectrum that you get to calibrate as well and say, well, I want to have a platform where someone else is taking care of the things that are not driving competitive advantage for me, managed connectivity to an ecosystem of third-party fund admins and providers, managing the data quality and a number of other tasks, reconciliations, this and that, but wanting to build the parts that are going to drive differentiation, the analytical aspects, the dashboards to consume the right information at the right time by the PMs, by the managing partners. And technology allows for that today, to do some building to the extent you want to and self-service that.
How much do you think the investment team understands the importance of all the technology solutions to help them build their business?
It's a mixed bag. The investment teams are spearheading the growth of those businesses, and they need what they need when they need it. And at times, as we spoke earlier, they're seen much more imminently than ever before the fact that data and technology can become a deterrent for growth, and or those more forward-looking can be a differentiator as well, if properly seen and approached.
On that point as well, how much do you think technology provides leverage to smaller firms versus it actually gives the bigger scaled firms who have more data, more resources, even more of an edge?
There's certainly some leveling of the playing field to a certain extent because we think about some of our technology being consumption driven. So the entry point for someone launching a new fund for the first time and being able to establish a good foundation of infrastructure, they're much more able to do so today than ever before. Clearly, the larger firms are also doing very. Take a large firm, one that has multiple business lines across private equity, private credit, that might have recently acquired another firm, and now they're looking to centralize a function, say investor services or across all of the different distribution channels, so that the experience for the investor across retail and insurance and pensions is, and as they invest in the co-invest and the SMA and the Evergreen, is all the same. Most are still operating in a very fragmented way, given their legacies of how that growth came about. So you can use technology to now put a client experience at the top of the agenda and be able to realize those cross synergies.
So I think as we head towards a period of consolidation in private markets, large firms are going to acquire specialists or firms that have very specific niches and strategies. There's also going to be people who spin off and decide to start their own new firms. Do you think that we're at a place in private markets, market infrastructure from a technology perspective, that firms are going to build their business with technology at the outset of how they think about building the firm's operations and that gives them leverage? And are we at a place where the technology is good enough where it can actually help a firm scale quicker than maybe in the past?
Yeah, for sure, technology today can help a firm scale quicker. I think the more important aspect of your question there is in markets like this, where there is so much uncertainty, and private markets firm thrive in uncertainty and coming up with new strategies, but that requires a lot of flexibility. So yes, you want to invest in infrastructure early on, and yes, the technology might be there to do so to a certain extent, but you still don't know enough as to where you're going to pivot your business towards.
Are there areas where technology can play a more important role? So you've thought a lot about private credit, ABF as an example. That's a growing segment of private markets. It's also a growing segment to serve the wealth channel. How does technology and the work that you're doing intersect with everything that's going on in private credit and ABF?
It is a very important area of growth for our clients today, many of whom are private credit firms that had already been to a certain extent in asset-based finance, or are coming into it through acquisitions or building their teams, have an expectation of it being of it becoming a core as direct lending has become to their firms over the next few years. And that brings all sorts of new things into the fold for them. On the investment side, the obvious one being ABF can mean a lot of things. Many of those things are a much higher volume than a typical direct lending fund, where you might have 100 loans. You might have 100,000 in an ABF fund.
What does ABF mean?
Oh, yes. Asset-based finance, by compare and contrast direct lending being the lending to corporations. Asset-based is distinguished by it being the lending against the contractual cash flows of some asset, either real or financial. It can be a consumer loan, it can be a residential loan, it can be accounts receivable, it can be equipment, it can be a piece of infrastructure, anything. Litigation. That is a very big addressable market for firms, as private solutions in the asset-based space are a tiny fraction of the total securitization market. And not unlike direct lending over the last dozen years, those same forces of regulation, accentuated recently by regional banking crisis and evolving capital requirements, are pushing asset-based to the private world.
How much did firms who were in direct lending use technology? How much are firms that are moving into the ABF space using technology? And maybe talk a little bit about the distinction between why it's so important to use technology in ABF, given how many underlying loans may be part of an ABF product or securitization.
Certainly, there is the volume problem to deal with, to wrestle with. In the same way, direct lending is more operationally intensive than private equity. Asset-based finance is more operationally intensive than direct lending, generally by a factor of n in terms of numbers. But it's not only that. It is also, there is a new ecosystem, a different ecosystem in each of the underlying asset classes of players that you are working with. It might be originators and servicers, alternative lending platforms in the case of the consumer world, originators of mortgages, non-bank originators, a different set of players that you are going to be coordinating and doing work with and exchanging data with. And the data has much more activity than that of a loan you extended to a private company. It's changing daily. You might be on a forward flow trade where you committed to purchase X amount of billions of dollars over the next 2 years, and loans are being originated every day, all the time. So you have to consume that information. You have to understand it bottoms up and understand what those loans are for, who are they being made to be able to underwrite them and monitor them and address potential problems downstream.
How does the entrance of the wealth channel with evergreen products or interval funds that require monthly, in some cases daily NAVs, how does that play a role in all of this?
It compounds the operational and data challenge dramatically. Because now you have what we just described coupled with a much higher frequency of reporting, or even daily in the case of, say, interval funds, which are adopting asset-based finance strategies as an important one in addition to direct lending. And having liquidity also makes the valuation process that much more important as money's coming in or flowing out of those funds periodically.
This is interesting, especially given that you worked at your previous employer has been innovative in creating private public hybrid products. ETF, the Apollo State Street product is what I'm referring to in this specific case, but there's a whole proliferation of really interesting partnerships and hybrid products that are combining public and private exposure into a single product. How much is technology playing a role in making sure those product structures actually work in the way that they should?
Absolutely. Technology has to play a very important role as everything speeds up. And you have different illiquid tradable listed assets having to that look very differently, whose data schemas and formats have to be harmonized and come together on a much more real-time basis. Technology has to absolutely play a role. It's not an option.
How do you think the product innovation will continue to evolve?
I hear your podcasts and interviews, and I find them very interesting. You have much more informed views on this topic than I do, but I can only imagine private markets being an integral part on the everyday investor, on the retail side, on my 401, even on any type of fund that's available to retail. There will be a private component in the next few years or so. How quickly it is adopted, who knows? There's different barriers, technological and otherwise, as to the adoption of private markets in a defined contribution plan, for example. But that is clearly the direction where we're going.
If you could wave your magic wand and say, I could solve this technology problem in private markets today, is there something that you would say, I wish this was available and created from a technology perspective to be able to solve this problem in private markets?
Well, I'm gonna be a little bit, I guess, parochial here or biased. When I think about Arcesium, when I think about the business I'm responsible for, well, we operate in a business-to-business environment. Eventually, some of our clients are moving into a business-to-consumer world. But I wish if I could use a magic wand for the whole process of selecting technology, testing it, and proving it out to be much more simpler as it is today in a consumer environment where you can go and check out an app and do a trial. And I think that certainly is much more complex in a B2B environment.
I think you bring up a really interesting point in two contexts. So one is, if you think about the people who are going to be users of technology, even in a firm, in a B2B context, I think the same is true for capital markets trading. You know, you look at the way that now younger traders, they've grown up social. I think you can make the same corollary here where people in private markets, they may be millennials or younger and maybe big users of technology. They have to have a good experience, and the user experience matters. How do you think that will impact how both people at the firms using the B2B product will think about the experience that they need to have? But then also the other interesting point here is as private markets does go more into the mainstream and it does work with the end consumer, financial advisor or end client, you do have to create a good experience for clients. And that experience has to be done through a high quality delivery of technology. So how do you think private markets technology can, whether it's in a B2B or a B2C context, actually do a better job of creating a great consumer technology experience?
Yeah, we need as an industry to move in that direction. And I think it's first starting with the LP, the investor in mind as the end consumer. The investor is most important to our clients, and they want their experience to be akin to that of their apps on their brokerage account. And that's the first frontier. For us, where our user base is much more so the manager and their employees, it is very important for us to take a consumer like a very intuitive self-service user experience to them and facilitate the adoption of new tools. And my magic wand would be for them, not only once they adopt them, but even as they're selecting them, to be able with ease to try them out in a context that resonates with them, where they can use some of their own data and play with it and see it at work.
That's a really interesting point too, because it's only when you actually try the technology and you see it come to life that it actually really starts to show whether or not this is something that can be used versus something that's not.
Part of the reason for me to bring that up as the magic wand is that I'm itching to see us go out with something in this direction, which we will soon. We are going to be attempting to bring forth ways for our prospective clients to evaluate our technology in a much more hands-on setting. And I think that's really important because at times this, there's no way of comparing the level of complexity of the systems a large complex private market manager uses versus a consumer app. But there is still a lot to be done to make them much easier to use and evaluate. And that's where we're trying to push the envelope.
You mentioned the point of making it easier to use. Do you think that technology and innovation in better technology for the managers themselves will actually cap or reduce the need to hire more people in the firm's operations to be able to do the job that they want to do at scale?
Yes, absolutely. No doubt. It is still very early days with a lot of Gen AI use cases. We launched our Copilot last October. It is being used for translation of English natural language to SQL. So you can now go and take a look at your dashboards and configure them as a way to experience and analyze the data. You can use the Excel plugin, you can egress it to another system, and now you have the Copilot, and you can just ask the Copilot, go and get me this, do this quarter-over-quarter comparison, do whatever. And that's a start. So it is an encouraging start. We are using it to help our developers review and test code, and we have a pipeline of use cases, and that's going to be fueled mostly by our clients telling us where they want to go.
Where do you think Gen AI will have the most impact on alternative asset managers and their operations?
I think that helping them eliminate the need to spend a lot of time finding data, bringing it together, validating it before they can actually do something that drives decision making, do some cool analysis. they're going to be able to compress that time by asking the AI to do that for them in a progressively simpler way.
How far are we from Gen AI really having a major impact on the way that alternative asset managers do their business?
Hard to tell. There's a lot of encouraging early signs. Our focus as a firm is on enabling AI to be taking it to its ultimate consequence by providing a single source of truth, the right data foundation for Gen AI to operate. Where it goes from there, too early to tell. I guess I'm a little bit conflicted into having been 20 years at this. I still think there's going to be always a very important human aspect. But certainly as a productivity tool, it won't take decision-making over anytime soon.
So people are still going to play a really important role.
Absolutely.
How do you think about the future of marrying people and operations with the technology that you're building at Arcesium?
We take a data platform where we are trying to bring all of the data together from different sources. And the operations professional is now going to be relying on, after having instructed the AI as to how they want the data and in what shape and form to perform a task. And they're going to be working together as if they were colleagues of sorts over time. It will improve productivity and allow them to focus on the more analytical tasks.
What's the next phase of helping asset managers improve productivity as you think about the technology that needs to continue to be built in the space, particularly things like, I think, post-investment references than pre-investment, right? And those things are harmonized. If you do a better job of collecting, tracking, analyzing all the post-investment data, then it actually helps and serves the investment team, the IR or wealth solutions team. So it all kind of is harmonized together. But what are the things that need to be done, the next step in the space to make the post-investment process easier?
One of the big things that we hear from our clients is that they're no longer a pure private credit firm, let's say, to pick a strategy or to pick an area. They might still self-identify as a private credit, but there is now a much more complex portfolio of credit investments ranging from liquid to the tradable to the listed, and ranging from direct lending to asset-based, performing, non-performing. Very eclectic and complex bag. And one of the things that they are looking for is to have a platform that can attend to the needs of such a diverse set of instruments from a single place. To what end? Not only the operational productivity savings and the streamlining of the workflows of investment operations and accounting professionals, but also to facilitate quick time to market when launching a new product, to facilitate comprehensive and consistent reporting across LPs that are now invested in different strategies, and to facilitate decision-making by their leadership.
I want to switch gears and ask a question that I ask everybody. It's a little bit different than talking about the technology side, although could potentially relate. What is, in your mind going forward, your most interesting or compelling alternative investment?
You mean...
could be anything. You personally, what you think is going to be most interesting in private markets going forward?
From a personal note, since I've been at private markets for a long time, I've been trying to myself allocate more and more into private markets as I have a view and conviction. But it's been hard. Even gaining access a number of years ago was tough, right? And finding different ways, it's becoming easier now to gain access. I think I would like to see the day where I can have in my app where I attach all accounts to checking and savings and brokerage and aggregate. I'd like to see also private market investments and some even drill down capabilities to understand overlapping exposures across public and private. Understand in different ways through different lenses where the risk lies and what the performance is. I think it will eventually happen. That is what our clients are seeking today for their own management of their companies in a more real-time basis. That's where the end consumer and investor will be expecting as well.
The great news about that is what you're building today is you're helping to create the world that you want to see for yourself in private markets.
Yes, that's right.
I love that. Well, that's fantastic. I mean, this has been such an interesting conversation. There's so much happening, the intersection of data and alternative asset management and bringing in the wealth channel, and you brought that all to life. So, Cesar, thanks so much for coming on the show.
Thank you, Michael. Happy to be here.
Pleasure to have you. Thanks for listening to this episode of Alt Goes Mainstream. I hope you enjoyed it. You can read more about alts at my Substack, altgoesmainstream.substack.com. Thanks a lot and have a great day.
We're going mainstream.